Hey, what is going on, guys? My name is Nick, and if you're new to the channel, welcome. So I think we all know what this video is about. Over the past week alone, the stock market has been getting absolutely destroyed, with the indices falling over 10% in 5 trading days. In fact, the sell-off has actually been the fastest correction we've seen, and much of the market's reaction is occurring because of a certain sickness spreading across the globe involving a famous type of Mexican beer. I think you all know what I'm talking about. But all jokes aside, because of many of these videos being demonetized on YouTube because of this topic and speaking about this sickness, I'll be referring to it as CV, so I really hope that you know what I mean there. So basically, the CV has been causing so much fear and panic across the globe, and finally the markets are reacting accordingly, which has led to the massive sell-off that we saw last week. As a result, many companies that sell products or sell services that involve a human interaction element whatsoever, like cruise lines or airlines where you're constantly around people, these stocks are getting absolutely hammered. But honestly, it's not too surprising seeing the huge correction that we're having right now, considering the huge rally that happened in the market at the end of 2019 and also leading into 2020. And if you're a new investor to the market, you're probably freaking out right now, but fear not. This is actually becoming one of the best times to buy stocks in the market because of all the great deals that are presenting themselves right now. Now, in my opinion, the CV is just completely overblown, and the market is just using it as an excuse to correct itself because stock prices were way too high going into 2020. But I truly don't believe that this will have any long-term material effect on the market or on companies, and I don't think that it'll lead to a recession. So I've been keeping track of my stocks lately, and I've found some pretty good deals popping up in the market lately. And so in this video, I'm going to be sharing 10 different stocks that I've been watching and that I could be potentially buying in the correction that we're seeing. So if you do enjoy this video, make sure to give it a big thumbs up. I really do appreciate your support, and a ton of effort went into this video to research these 10 companies. Also, if you're new here, definitely consider subscribing down below for more weekly content just like this. And with that said, let's jump into these stocks that are on sale right now. Alright guys, so since we have so many different companies to look at today, I'm just going to give you a quick and dirty summary of each one, so let's get into it. Now, the first stock that I have on my list today that's on sale at the moment is Prudential Financial, ticker symbol PRU. Now, this is one company that I've never spoken about before on this channel, but I think it's providing some really good value right now. And so this company is essentially an insurance and investment management company that provides its services to people across the US and 40 different countries around the world. And despite having its earnings rise over the recent quarter and year, the company's stock price has been punished dearly, especially with the news of the CV hitting the media. So when taking a look at the company's stock price performance, we can see that they have done very well over the long term, but lately not so much. So the stock is nearly down 29% in the past year alone from its highs in 2019. And then if we look at its highs from 2018, the company has dropped over 40%. Now, taking a look at their valuation, Prudential Financial has a current PE ratio of 7.7 and then a forward PE ratio of 6.3. And when comparing this PE ratio to the 5-year average of 10.3, it's clearly undervalued. Now, another indicator that I like to look at for many companies is the price to earnings growth ratio, which takes into account the growth rate of those earnings over the years. And right now, Prudential Financial is sitting at a PEG ratio of 0.44. So anytime that a company is below a PEG ratio of 1, it's typically signaling a pretty good value. Now, the final valuation metric that I like to look at is the price to book ratio, because this is a financial corporation with a lot of assets. And right now it's sitting at 0.49 with a 5-year average history of 0.8. So already we're seeing this company check all of the boxes in terms of its valuation, but what I haven't mentioned yet is that they pay a dividend. And the forward dividend yield on this company that they're going to be paying out in 2020 is 5.7% with a payout ratio of only 40%. And guys, just to give you some context, any company with a dividend yield above 4% and then a payout ratio below 60% is really good. And I also looked at their dividend payment history, which ends up being about 6 years of growth, which is pretty good. And right now, since their payout ratio is fairly low, it seems to be a manageable dividend and should be increasing over the near future. So if you do want to gain some exposure to the insurance industry, this is one stock that I would pick. All right, guys, now the second stock that I have today is probably the most popular stock that everyone's talking about on YouTube right now, and that is Carnival Cruise Lines with ticker symbol CCL. Now obviously, because this is a cruise line stock and a lot of people would be around other people if they went on cruises, they're not doing too hot right now with the CV spreading across the world. And so as we can see from their charts, the stock really has not been doing well, especially recently with the CV news coming out, and it's been extremely oversold in my opinion. In fact, the stock price almost dropped from about $43 per share to $30 per share in a single week, but then gained support and rebounded. Now looking at their valuation, we find that Carnival's current PE ratio is 7.4, and then their forward PE ratio is lower than that, being 6.9. And not only that, their price to book ratio is below 1, being 0.89 right now, which means that the company is actually trading below its net asset value. So if it liquidated the entire company and all of its assets, it would be worth more than the company is trading at right now. Now, another thing that everyone loves about Carnival Cruise Lines is their sweet dividend. And right now it's sitting at a forward dividend yield of 6.3% with a payout ratio of only 46%. And with their track record of growth on the dividend, along with the payout ratio being so low, I couldn't see them cutting it in the near term unless something went horribly wrong in the company. So I think this should be a good play. And as I spoke about in my earlier video, I do own Carnival Cruise Lines, and I've actually been averaging my position down. I think I have an average cost basis now of $39. So I am underwater, but I plan on buying more into the future, and we'll see how that goes. All right, now the third stock that I have on my list today is another one that's been beaten down extremely hard, and that is Delta Airlines, ticker symbol DAL. So obviously with the CV going around, not a lot of people are going to want to be flying because you're around so many other people and going to these airports that are congested. And not only that, but many flights have been canceled to China especially, and many others across the world because of the CV happening. So just over the past year alone, the stock price is down nearly 27% from its highs in 2019, but then recently the CV has absolutely been destroying the stock price because of the impact on the airline industry as a whole. And that of course brings us to Delta's stock price valuation with their current PE ratio of 6.6. Now if we contrast this to their 5-year average historical PE ratio of 11.6 and then the industry average PE ratio of 22.2, obviously Delta is pretty undervalued right now. Now along with that, the company has a price to earnings growth ratio of under 1, being 0.73 right now, so you know how I feel about that. And then for their price to book ratio, it's the same thing as their price to earnings ratio. It's undervalued based on every front. Now another great thing about Delta Airlines is that they do pay a dividend, and right now their yield is sitting at about 3.3%, which is pretty good for an airline stock. And then they're easily going to be able to manage that dividend with their payout ratio of only 21%. I mean, come on guys, this is ridiculous. So with a good history of dividend growth over the past 5 years, along with their low payout ratio, I see no problem with this stock right now, and I think that it's severely undervalued in terms of both its dividend as well as the price to earnings ratio. Alright guys, now the fourth stock that I have, and one that I've actually been looking at even before this correction to try and buy, is International Paper with ticker symbol IP. Now International Paper is one of those companies that is probably never going to go out of business. They've been around for over 100 years, and they produce products like cellulose fibers, cardboard boxes, and papers. But unfortunately, the pulp and paper industry is really not doing that well right now, and this correction is just adding to the pain of the company. So as we can see from their stock price, it's down 43% since its all-time highs in 2018, and then down just about 23% in this year alone. And getting into the company's valuation, we find that their current PE ratio and their forward PE ratio are both just above 12, which are lower than the 5-year average history and the industry average. Now the other great thing about International Paper stock is that they do pay a hefty dividend with a forward annual dividend yield of 5.5% and then a payout ratio of just about 66%. And even though this payout ratio is slightly above 60%, I would not be concerned about it in the slightest because it's very close and they still have a long way to go for their earnings to not cover the dividend. Along with that, they do have a fairly good history of paying that dividend and increasing it since the Great Recession, so I think they should be doing fine over the near term at least. Now, the fifth stock that I have on my list today is a very controversial one that I've talked about in a previous video, and this one is Boeing, ticker symbol BA. Now, ever since since the crashes of the 737 MAX airplanes, Boeing has not been doing too well, holding about a $330 to $350 share price over the past 2 years. And to be honest, I think it's pretty amazing that the stock has been able to hold support since mid-2019 without having any sales of their star jet being the 737 MAX. But of course, Boeing has not held support throughout this correction, and they've actually dropped below $300 per share, and the last time they were at this level was over 2 years ago in December of 2017. And if we look over the past year alone, the company is down nearly 38%, where most of the drop is of course due to the recent sell-off. Now this is the part where I would get into the valuation and tell you how cheap it's looking right now, but to be honest, I can't do that with Boeing because their forward PE ratio is 44.4. The company's actually looking very expensive right now according to valuation metrics, but what you need to understand is that the potential value of this company is priced into the stock. And if you believe that the regulators are going to eventually sign off on the 737 MAX and it'll eventually fly again, then Boeing's probably a pretty good buy right now, and if not, then Boeing looks very expensive. But in my personal opinion, this is too big of a company to fail, and I think that regulators are eventually going to sign off on the 737 MAX, and it will eventually start flying, and they'll make a ton of sales, so the price right now is probably not too expensive at all. And along with that, you can't forget about the dividend that Boeing pays, and right now the yield is sitting at about 2.86%, which is pretty good. And they should be able to continue growing and paying that dividend well into the future, provided that the regulators do sign off on the 737 MAX aircraft. Alright y'all, we made it to the halfway point, so we're up with stock number 6 right now, and that is ExxonMobil Corporation with ticker symbol XOM. Again, I've already talked about this stock in a previous video, and I thought that it was undervalued at the time, being about $64 per share. But boy was I wrong, this stock has tumbled insanely. And it seems like energy stocks got absolutely destroyed in this recent correction. I'm not totally sure why, but it's probably compounded by the fact that there's weakness in the industry right now. But regardless, I think there's some really good value in ExxonMobil right now, with their stock price sitting just above $50 per share. And taking a look at their stock chart, we can find that they're actually down 45% since their all-time high in 2016, which makes it look very attractive at the moment. It's also pretty insane to think that the stock was last found trading at these levels in 2005. And so with all of the poor performance lately, that's given them a current PE ratio of 14.8 and then a forward PE ratio of just about 14. And because this is an oil and gas company with a ton of assets, we want to look at their price to book ratio, and that is sitting just above 1.1 right now, which is basically just above its net asset value. And guys, like I talked about in an earlier video, ExxonMobil is a great dividend paying stock. They have a forward yield of 7%, although their payout ratio is slightly above 100%. But I can see this payout ratio going down quite a lot in the near future with their high capital investments, along with the company paying the dividend for so long. I highly doubt they would cut it. Alrighty, now it's time to get into the technology industry with stock number 7 today, and that is of course Facebook, ticker symbol FB. If you didn't already know, Facebook is not just the Facebook platform, they actually own Instagram, WhatsApp, and Messenger, among many other companies. And although they've had a really bad spotlight in the media over the past few years, the company is still growing at tremendous rates, and I think that they're really undervalued at the moment. Now in the recent correction, we actually find that the stock price has only fallen about 13%, which is very little for a technology stock right now. But in my opinion, that's because Facebook was already so undervalued going into this correction that no one really wanted to sell the stock. There were so many bulls buying it. So currently we find the company sitting at a share price just above $190 per share, and in my opinion, anything below $200 per share is a steal for Facebook stock because they are such an amazing cash heavy tech stock. And taking a look at their valuation, it tells the exact same story with a PE ratio just below 30 and then the forward PE ratio at 20. And with their PEG ratio being only 0.85, this shows incredible earnings growth for the price that it's trading at right now. And guys, I'm not exaggerating this whatsoever. This is extremely low for a technology stock. Usually tech stocks are trading with a PEG ratio well above 1 or 2. And along with the high earnings growth, analysts are predicting huge revenue growth, being at about 20% throughout 2020. So overall, this is pretty amazing having a tech company this cheap right now with so much growth ahead of it in the Instagram platform and the WhatsApp platform. I would definitely take advantage of this if I had some cash. All right, y'all, coming in with stock number 8, and that is Suncor Energy, ticker symbol SU.TO. Now, of course, this is another energy stock, just like ExxonMobil, but trading on the Canadian side of things. Suncor is one company that I'm always going to have my eye on because, first of all, Buffett owns it, so that's a pretty good indicator. They also have really effective management, and then they reward shareholders through share repurchases, dividends, and capital appreciation. And right now, if we take a look at their chart, the company is trading at the support level that they've had over the past decade, which is usually a really good indicator that the stock price probably won't fall too much further. And not to mention that the stock price is down 32% from its all-time highs in 2018, it's probably worth looking into and probably has some pretty good value. And what we find is that their current PE ratio is sitting just below 20, with a forward PE ratio of just over 12. And seeing that their forward PE ratio is quite a lot lower than their current PE ratio, it signifies that they are going to be having some great earnings growth. Now again, because this is an oil and gas company, I like to look at the price to book ratio, and right now Suncor's trading at a 1.35 price to book ratio, and like I've said in the past, anything below 1.5 is usually pretty good value because you're getting close to that net asset value at a price to book ratio of 1. Now, another great feature about Suncor is their mouth-watering dividend, having a forward yield of 5% right now, and I can't remember the last time it's been at this level, so I'm going to be taking advantage. Now, you might find that Yahoo Finance is showing their payout ratio above 90%, but in reality, based on future estimates, it's going to be below 60% because they are growing their earnings over the next year. And with a company that's been paying and increasing their dividend for so many consecutive years, it's really hard to go wrong with this one, so I'm going to be buying at these low levels. All right, coming in with number 9, I hope you realize that I couldn't go a single video without talking about a Canadian bank stock. So here we have Royal Bank of Canada with ticker symbol RY.TO. I'm looking at Canadian bank stocks right now because they really haven't gone on a huge dip in a while, and we're seeing some pretty good value right now, to be honest. So because of the CV outbreak, the stock has dropped about 9% since its recent highs, which is actually a really big move for a bank stock. Along with that, it's really rare to find RBC trading below $100 per share on the TSX, so I think that this is providing some pretty good value. Now, RBC has a current PE ratio of 11.1 and then a forward PE ratio of 10.2. And RBC does pay a dividend, so their forward yield for 2020 is going to be 4.2% with a payout ratio of only 46%. So you guys know how I feel about this company. I'm really bullish on it over the long term. It's proven a great track record of performance, and that is why I bought 3 shares on Friday, February 28th at an average cost of $98.75. You're probably asking, why did I only buy so few shares? And that is because I was at a lack of cash in my account at the time. So we'll see how that's going to be going over the future. And finally, we reached the last stock on the list today. You're probably wondering, did I save the best stock for last? Well, it is quite possible because that stock is Tesla, with ticker symbol TSLA. Now, I posted a video about Tesla a few weeks ago talking about how I wouldn't want to buy at these current levels because the stock price was way too overvalued. And basically I said that there was a large chance that if something went wrong, the stock price could plummet very badly. And what we saw over the past week is that the stock price dropped 27% in basically 1 week alone. Now, this is primarily because of the weakness in China at the moment. And as we all know, Tesla is starting to ramp up production in the Shanghai Gigafactory, which was about 1,000 cars a week in late 2019. So this is obviously some bad short-term news for Tesla. However, I think we are finally starting to see a little bit more value in Tesla, which is why I put it on the list today. So the only valuation metric that I do have for you today is the forward price to earnings ratio on Tesla, and that's sitting at 48.1 right now. Now, obviously a PE ratio of 48.1 on its own really is not that cheap. It's very expensive, but if we consider the future potential like that in Boeing right now, I think that this could be providing some pretty good value. And if you want to consider Tesla as a high growth technology company rather than a car company, the valuation does make a lot more sense. So I don't know if it would get down to this level, but I would consider starting a position in Tesla below $600 per share and just to see how it goes, and then potentially build it up even further if they crashed even more. But by no means am I putting my entire life savings in Tesla. I still do think that it's a slightly speculative play, but it does provide some pretty good risk return right now. All right guys, so if you made it to this point, you made it to the end, so definitely make sure to comment down below 10 out of 10 just to tell me that you stayed this long and confused everyone else in the comments section. But anyways, I do really appreciate it that you stuck around until the end. Let me know what you thought about these picks down below and if you're buying any others that I should consider. So if you did enjoy this video, make sure to smash that like button for me and then consider subscribing if you haven't already for more content on personal finance, business, and investing in the near future. So good luck out there in the market, and I will see you guys next time.